Welcome to the Real Freedom Podcast, where we inspire you to pursue your passion to gain time and financial freedom through opportunities in real estate. I'm your host, Mike Swenson. Let's get some real freedom together. Hello, everybody, and welcome to another episode of the Real Freedom Podcast, where we talk about building time and financial freedom through opportunities in real estate. And I'm really excited about today's guest for you. We've got Jeremy Dyer. Jeremy's going to have a very unique perspective that we haven't necessarily had on this show before. Jeremy works a W-2 job. So right out of college, you worked with a sales career, moved to the top of the company, actually kind of entered in real estate as an investor, as a passive investor, and have invested in 4,000 doors and 24 deals. We'll talk more about that. Private equity of over $400 million in total assets. But then now you're at the point where you're raising capital. And so you're still working your W-2 job. You are a passive investor and now starting to raise capital. Hailing from Minnesota, we have to give props to another Minnesotan on the show. Jeremy Dyer, we're so excited to have you.
Mike, thank you for having me.
Why don't you just go ahead and just walk us through your journey of getting into investing and then exploring real estate as an investment opportunity?
Yeah, I'd be happy to. Thank you for that. So I really got started in real estate after I had risen to the top of the chart, so to speak, in my professional day job. So for a number of years now, I've been a high achieving sales professional, and it got to a point in my mid-20s where I had reached a point where I kind of quintessentially had everything I needed, so to speak, right? I had the dream home paid off, married, had 2 children, 2 more were on their way. So we went from 2 to 4, had the 40-foot RV sitting in the driveway. And I was, really kind of at the pinnacle, so to speak, of my financial life at that time. And I also had a burning desire to get into the real estate industry by actively owning and managing real estate properties. So my wife and I decided, while our kids were young, that we were going to start up a fix and flip business. And we did that. My wife had a knack for interior design. My dad was a general contractor, and we fixed and flipped houses, some of which we rented out. Others, we walked away with $20,000, $30,000, $40,000, $50,000 in additional equity, through those reposition efforts. The challenge was a few years into that, in order to scale that business, we were going to really have to increase the amount of homes that we were flipping on an annual basis, or rentals that we were taking into our rental portfolio. So the challenge we had at the time is that my 2 older boys were active in year-round sports. The 2 younger ones, were starting to get active in their different activities and sporting events. And we were realizing that the real estate side, on the active side, was really becoming a second full-time job for me. And I was just simply spread too thin. I certainly could have managed the second business and likely have done it well, but it would have been at the direct sacrifice of not spending time watching my kids grow up. Okay. So my wife and I decided back in 2015 that we were going to exit the active fix and flip business and instead focus on our family. While at the same time, I learned about real estate syndications. Okay. At the time, I didn't even know what the word syndication meant, other than I knew the Green Bay Packers were a syndicated football team. Okay. So back in 2015, 2016, I made my first decision to invest passively as a limited partner into a real estate syndication. I used what I call the shotgun approach. I held my breath and I plugged my nose. I sent in my 6-figure wire transfer. And 3 years later, I had doubled my money in that particular investment. And from that point forward, I was hooked on the strategy. So now fast forward from that first moment in 2015 and 2016 to today, 2023, I'm now a limited partner investor or passive investor in 24 different investments, most of which are in the multifamily space. However, I have also explored other asset classes like self-storage, assisted living, flex office, and retail, to name a few. And because I have really fallen in love with that type of an investing strategy, it has also afforded me the ability to start to raise investor capital for sponsors that are looking to acquire additional multifamily assets. And that's really where my side hustle, which is known as Starting Point Capital, was birthed, which Starting Point Capital exists for the sole purpose of educating other investors on the investing strategy in real estate syndications and really helping sponsors to raise that capital that they need to acquire those assets.
Yeah, that's a lot of stuff. And just to hear you talk about it all, you've got a high paying sales job, you've got a family, they're very involved in sports and other activities. And to be able to have your side hustle be that extensive really speaks to, I think, the tenacity with which you attack things. I think for a lot of people, that was one of the aha moments I had. Was I had interviewed a guy who was actively investing in real estate. I think he had a fourplex. And he was talking about how there was a weekend, the unit needed to be turned, and he took the entire weekend and painted that unit. And he said, I looked up, he had a family and kids, and he's like, I've got 52 weekends in a year, and I just burned one painting a unit to be able to turn it, with the whole point of doing this for my family. So I'm taking time away from my family, which kind of was counterintuitive, the idea of, I want to be able to spend more time with my family. So obviously, passive real estate investment, you saw that as an opportunity of, okay, I don't have to be hands-on. I don't have to personally talk to the property manager or do all that stuff myself. So talk about kind of that moment of realization where you're like, oh, I can still achieve my financial goals and not have to do the toilets and all that kind of stuff at the same time.
Yeah, that's a really good question. I would say that my aha moment took place when we had acquired and fix and flipped our last property. Okay. And 30 days out from being ready to put that property on the market, we learned that the septic system had failed. Okay. And for the low price of $35,000, which ate directly into the profits, okay, the profit margin that we were looking to achieve on that particular asset was gone. Okay. In the blink of an eye. So that was really our kind of aha moment. Second to that is we had enough track record at that point with other properties that we were actively fix and flipping that I knew what the margins were. Okay. At least the margins that we were able to achieve relative to the amount of effort that we had to put forth to achieve that margin, so to speak. Right. So one of the aha moments then is once I got into investing passively into real estate syndications, I realized very quickly that I get very similar tax benefits. I receive very similar, depreciation benefits as a direct result of passively investing into those assets. And also I receive, very much similar on the equity side, the forced and natural appreciation that I was receiving through the fix and flip efforts, right? And the cash flow. And ultimately, when those deals were going full cycle, the equity split that I would receive when those properties went full cycle was very similar to the amount of capital that I was putting in as an active real estate investor in those single family fix and flips.
You highlighted it well. And two, being able to offset your regular income in your W-2 job. I'm curious to learn more, like when you're talking with other high paid sales executives, what are those conversations like to be able to say, look, I've got these assets here that are offsetting this income for my tax benefits? Is it kind of this aha moment where like, oh my gosh, I need to be putting some more money into real estate too, to take care of that, that benefit that you receive?
Yeah, great question, Mike. I would say that for myself included, the investors that I talk with on a regular basis, are really more so after time freedom. That's the one thing that none of us can create, and that is more time. I can always create more money. Okay. I can always spend more time in my W-2 job to create a higher W-2 for myself. I can always start one side hustle, two side hustles, or 10 side hustles, right? We can always create more money, right? The one thing that we cannot create more of is time freedom. We all only have a certain amount of time in our lives. Okay. And so for me, the big, pull to doing it on a passive level where I'm trusting the sponsor to execute the business plan versus myself was a huge draw to me, to know that I wouldn't have to spend more of my precious time away from my children and my wife and growing my family, but rather I could turn that capital over to a sponsor that I didn't just know, like, and trust, but a sponsor that I knew would be a good fiduciary of my capital, right? Capital preservation, and where I felt confident and comfortable in the market and the strategy, and really that sponsor being able to hit the return projections that they projected to investors when they originally rolled out that opportunity.
Let's dig a little bit deeper to that, because you have had an experience seeing lots of sponsors, having seen deals come all the way through the life cycle, and being able to either choose to place your money with them again, or to say, you know what, thanks, that we had a good time. Now I'm going to go choose somebody else. So talk about what you're looking for in a sponsor and some of those key pieces for you to say, yeah, my money's good here. It's more than, like you said, just the know, like, and trust. It's, I've seen them execute on this time and time again, and I feel like my money is going to hit that target better than what I might find in some other sponsors' deals.
Yeah, good question. I would say that a lot of it comes down to the integrity of the sponsor, which it takes time to learn what that integrity level looks like. Second to that is going to be their track record and their transparency, both of which are incredibly important. So as I evaluate other sponsors that are in the space and other deals that those sponsors are presenting, I'm really looking at a couple of primary things outside of, going through the pro forma and coming to the conclusion that the sponsor's projections are going to be met, right? That's really a crystal ball question more than anything. But on the top of my list are really, what is that sponsor's track record, right? How many deals have they had that have gone full cycle? Okay. What have the returns looked like to their limited partner investors on those opportunities? If the sponsor has had some rough patches, which I hope that they all have had, I would like to know about them. Okay. The one thing that's true in the real estate business is it has a tendency to fall apart on a lot of different levels. I'm stealing this from one of my colleagues, but birds fly, fish swim, and real estate just has a tendency to fall apart. Okay. It's just what happens in the business. So I want to know that the sponsor that I'm investing with has really been battle tested. Did they go through the 08-09 global financial crisis? Okay. Did they survive the COVID, crisis, right? Did they have a deal that maybe struggled to meet their debt service coverage ratio, right? Did they have a deal that struggled with occupancy? Okay. Do they have a deal right now that has a floating rate bridge loan and they're struggling to make interest payments on that loan, right? So I really want to know that I'm working with a sponsor that has that proven track record, has been battle tested. And more than that, I want to know what their communication style is. Okay. So does the sponsor communicate with their investors on a monthly basis, a quarterly basis? And are they willing to tell their limited partner investors not just the good news and paint this optimistic picture of the future, but are they willing to tell their limited partner investors the challenges that they've had in the last 30 days since they sent out their last investor communication?
Absolutely. And curious to know, when you're talking about analyzing the numbers, you want somebody that's going to tell you the truthful story versus kind of the pie in the sky story. So for people that don't know, when you're analyzing syndication deals, you've got kind of the breakdowns, the pro formas, the projected returns, and those numbers are just projections, right? And so how do you know whether I'm going to get that, I'm going to get less than that, more that? You might have somebody that wants to pump up the numbers so they can get your money. You might have somebody that wants to under promise and over deliver. So talk about kind of analyzing those numbers.
Yeah, it's funny that you say that, because oftentimes I see on investor pitch decks, the expected exit cap rate on a deal, right? Well, if your projected hold time is 5 years, how on earth are you able to project an exit cap rate being 5.5 or 6, right? What I'd rather see in an investor pitch deck is something that provides an exit cap rate range, right? This is what the return profile would look like at a 4 cap, a 5 cap, a 6 cap, a 7.5 cap, right? But really, at the end of the day, when a limited partner investor is looking at the projections, okay, it's garbage in, garbage out, right? So a couple of things that I like to really look at right away when I'm looking at the pro forma and evaluating the deal is the rent growth, okay? Is the projected rent growth in line with what the local competitive assets in that market are going to be able to achieve? Is the sponsor expecting 20% rent growths year over year? Or are they more realistic in a maybe 4 to 6% range? That's one thing that I look at right away. And most good sponsors will provide what those competitive assets in that same market are receiving right now for a new and improved product, right? Second to that is not only just job growth in that particular market, right? Because it's not just about the sponsor, it's also about the market that asset is located in. Because there's one thing that you and I both know you can't do in real estate, and that is you can't move the asset to a different market, right? So we're kind of stuck in that market with that particular investment. So I like to see not only realistic job growth projections, but also job diversification, right? We see what happened in Detroit, for example, during the automotive crisis, right? There wasn't a lot of job diversification in the Detroit market. So I'd like to see not just job growth, realistic projections, but also job diversification. Obviously, I like to evaluate the insurance costs, right? Sometimes sponsors will acquire an asset and not realize that after year one, the property management fees go up 20, 30, 40%, depending upon the market, right? Are they projecting a higher increase in insurance costs, knowing that if they project high enough, the hope is obviously those numbers are less than what they're projecting, or are they projecting something that's just completely unrealistic for that market? I also like to know about the financing structure, right? It's kind of a big news story right now, with where interest rates are at. So I'd like to know, is it fixed rate for how many years? Is it interest only, right? What's their plan in the hopefully unlikely case that interest rates continue to rise in the future, right? Have they stress tested that particular asset at multiple different interest rate levels? And then lastly, I'd like to know about the new development absorption rate, okay? I'd like to know about those competitive assets that are in that same market that are ground up construction, right? And what those absorption rates look like. So if a new developer is putting in a 160 unit apartment building in that same market, and they started construction 2 years ago, by now they should have generally a good idea as to what that absorption rate looks like. If that absorption rate is 60%, that's a red flag, right? If that absorption rate is 95%, then more than likely I know that there's still a high demand in that particular market for multifamily apartments.
We talked about time, right? And, wanting to be able to minimize your time as much. Having invested in 24 different deals, how much of this is you doing your own due diligence? How much of it is you working with your operator, doing their due diligence? Because obviously too, you're going to still need to verify what they present to you. And how much of it is maybe wanting to lean into a handful of markets. Hey, I really like these states. I really like these cities. So for somebody that wants to pursue this, maybe you're looking at your first deal or your first couple of deals here. It's like, gosh, it seems overwhelming to be in all these different markets, all these different assets. How do you kind of take that time to balance the due diligence plus working with the operator and what they're sharing?
Yeah, that's a really good question. Glad that you brought it up. And certainly you need to be able to trust the sponsor. And you can say trust. I trust a lot of people, okay, in my life, but there's a lot of people I would never trust to, put $20 million on an apartment, with a CapEx budget and hope to produce a 20% internal rate of return to their investors over 3 to 5 years, right? So there's that side of it as well, which comes with the experience level. So, certainly trust, but verify. My strategy when it comes to investing into real estate as a passive investor is all about diversification. Okay. It's not just about diversification of sponsor, but it's also diversification of market. Okay. So the 24 deals that I'm a limited partner investor in right now are in 8 different states in 4 different asset classes with 6 different sponsors. Okay. I'm a big fan of the same strategy that your financial advisor would give you as it relates to investing in Wall Street. And that is to diversify, whether it's amongst small cap stocks or large cap stocks. So when investors come to me and they've got additional cash on the sidelines, otherwise known as dry powder, and they're looking to invest that money passively into real estate, some of which, by the way, come out of the active space, and they're done dealing with tenants, trash, toilets, and termites. And so they want to move that capital into passive real estate investments. Oftentimes I'll encourage them not to put all their money into my next opportunity that I might be raising capital for, but maybe to slice and dice up that in chunks into multiple different properties that become available over the coming months or coming years.
It's nice being at the spot of 24 different assets, being able to split that out. But if I'm choosing my first 1 or 2, how would you maybe guide their decision making?
Yeah, good question. I guess, first of all, you've got to identify a sponsor with that proper track record that has a huge alignment of interest. Okay. When I say alignment of interest, I want to make sure that that sponsor is putting some of their own capital into the deal. Okay. What I like to see is I like to see a sponsor that is putting up at least 5 to 10% of their own money into that particular opportunity that they're looking to raise investor capital for. Second to that, I want to make sure that my limited partner investment, okay, or my passive investment sits next in line from the senior debt. Okay. What I mean by that is there's not a second party that gets paid first in what's called the waterfall. Okay. So there's a difference between a class A and a class B share, as an example. I want to make sure that my investment does not sit behind the class A share, which is usually just a preferred return that gets paid out to the limited partner investors, where a class B share would be equity plus cash flow, right? So I want to make sure that my investment sits directly behind that senior debt. And I want to make sure that my particular investment also has a preferred return that I am not guaranteed, because nothing is guaranteed in real estate, but I want to make sure that a preferred return exists of around 7 to 8% that I get paid annually, cumulatively, before the sponsor receives a split on that profit.
Yeah. And I know that's something that, we were at a luncheon together and you'd mentioned that about the preferred return being key, because you want to experience that quick win. If I'm putting up a large chunk of money, I want to be able to see something coming back right away. So talk about then the seeds that were planted as you're getting more and more experience as an investor, looking up saying, hey, I might be interested in raising some capital. So talk about that journey of kind of seed being planted to your intense learning curve of, I know you went through a pretty serious time where like, I'm committed to this, to where you're at today.
Yeah, great question. So I would say that learning acceleration really started back in 2021, where I realized the power of real estate investing. Not necessarily as the only way to invest, but certainly a way that not many people that are higher income individuals are currently participating in, mostly because they're unaware of that particular investing strategy. Most people's perception of investing is almost exclusive to either Wall Street, whatever their financial advisor tells them, or they believe that they're already in real estate because of the home that they live in, right? So that's really the extent of most higher net worth individuals' understanding, of real estate, or they believe that they need to go buy, grandma's house down the road, stick 50 grand into it, rent it out, and hope that they receive $300 a month in profit on an asset that they're going to spend countless hours in the evenings and weekends on as an active investor. So my transition really to Starting Point Capital existed out of my love for the strategy, number one. And then number two, me kind of wanting to evangelize other people, quite frankly, on the strategy. And I became so in love with it that I set up a website to educate people on the strategy. And obviously I would talk to all my friends and family and colleagues and coworkers and just anybody that I met, about what I was up to and how it impacted my own life. So really that's how Starting Point Capital existed. But I started building up a network of people that I was referring to other sponsors, right? Pro bono, referring them. It got to a point where I realized, hey, maybe there's a side hustle business that I could form, which is there which exists to help educate people on this type of an investing strategy, while also helping sponsors with one big thing that they need, and that is they need investor capital in order to acquire these properties and implement their value add business plan.
I remember listening to somebody that was raising capital for a deal, and they were talking about how, fast forward, he's like, if you can raise capital, you can pretty much write your own check to whatever you want to do, because people are going to need money. He's like, for me, that goal is, it's great to be able to raise, to be able to then manage the asset. But he's like, kind of ideally, the best thing would be is just to raise money and to be able to cash that check. And then I don't have to worry about the asset management piece, because if you can raise money, you've got a lot of freedom in what you can do, and you can go raise money for anything. It doesn't have to be real estate. It could be businesses, you name it. And so talk through, because I know you raise for a couple of different funds, but talk about that process and how that works.
So there's a couple of different ways that you can raise investor capital. One is by becoming a co-general partner, on the deal, where you show material participation in the execution of the business plan. And there's a number of boxes that need to be checked, there from a compliance perspective. Another one is through something called a special purpose vehicle, or SPV. It's a fund to funds model where the capital raiser essentially sets up a fund and collects investor capital into that fund. And then that fund deploys that capital into the investment. Many sponsors and syndicators that have any degree of volume, they typically like that fund to funds model better, because I'm essentially writing one single large check to the investment on behalf of my investors, versus those investors all going retail directly into the deal. So a lot of larger sponsors like the fact that I'm basically a fund manager. I'm an extension of their syndication team as a investor relations person, and I am able to have that relationship, so to speak, with that limited partner investor, which in the real estate syndication piece is incredibly important, that the limited partner passive investor has a pre-existing relationship with somebody that's a part of that sponsor level or syndication team.
And one of the themes that I hear throughout your story is it's relationships, right? Building good relationships with your operators, building good relationships with other investors, referring them, all your freebie referrals that you gave people, now being able to take that capital and say, look, that relational capital, and saying, look, if you trust me, here's another opportunity that's out there. And so it's the power of building and strengthening those relationships and providing solutions for what people are looking for.
Yeah, that's right. And I get asked the question a lot, because I would consider myself a self-proclaimed capital raising rookie of the year. Okay. Again, self-proclaimed, right? So others might argue with me on that, but many people ask me, how is it that you were able to be successful in the capital raising space while not really having to allocate a tremendous amount of time towards it? The time aspect can easily be addressed by the fact that I'm also personally investing into those deals myself. So I've already vetted that opportunity and am willing to put my own capital into that project. And with Starting Point Capital, I'm merely giving you the opportunity to invest alongside me into that same opportunity. And why is it that so many people have kind of followed me into those investments is really just comes down to one word, and that's reputation. Okay. It's taken me over 2 decades in my professional career to build up the reputation to the point where now when people learn about what I'm up to, they just desire to want to know more, right? And because of the reputation that I've built up with others over the years, right, my internal stock price with those individuals has increased. They know me as somebody that they like and trust and has integrity, right, and is willing to look out for them, so to speak. So I would just say that for any sponsors that are in this space that might be looking to raise capital or listen to this episode, I would say that more than anything, you need to become a better version of yourself. And we all have room and areas to improve in that department. Okay. None of us are perfect, but there's daily steps and daily action items that we can take every day to become a better version of ourselves. And if we do, genuinely more people are going to want to know more about what you're up to and likely going to want to participate in those opportunities alongside you as well.
Real estate agents, are you tired of letting the busyness of your real estate business get in the way of your real estate investing goals and your financial future? I'm excited to announce that we've created the Real Freedom Investor Agent Tribe to help you. We've got a ton of content, educational tools to help accelerate your learning curve and get you on the right path to hit your investing goals. We also have a mastermind tribe of people just like you, agents that want to grow their own portfolio and encourage you and cheer you on along the way, as well as some private one-on-one coaching. So go to realfreedom.com, click on the store, you'll see the options there. We're so excited to be able to help you. I've priced it super low so price can't get in the way, but did want to have some skin in the game for you to help with that accountability. So go check it out, realfreedom.com, click on the store. We're excited to connect with you and excited for you to connect with your tribe of real estate agents investing, trying to build their financial freedom. Yeah, and what would you say are maybe some of those key things for you that you're focusing on to essentially level up yourself each day?
Yeah, I would say right now I'm really trying to learn how to be a more effective communicator, not necessarily a verbal communicator, because I've done a lot of that over my years in my professional job, but it's really on the written side. So really finding out ways in which I can provide value to people through the written word and getting that information out to people through social media platforms, through an ebook that I'm currently in the process of developing, right, through my LinkedIn, connections. So really trying to find any way that I can to educate people, not necessarily with an opportunity to invest into a future deal, but ways that I can educate them about the space that I'm in so that I'm providing value to them, which also includes, by the way, recommending podcasts and books and so forth that exist out there from others.
One of the things that I love is when I'm working with real estate agents that want to get into real estate, or they're coming from another industry, and it's like, I'm doing this job in sales, or I'm doing this job as a teacher, whatever it might be, and now I want to get into real estate. And we talk a lot about leveraging your transferable skills that you have in your previous industry that you can now use here. And for somebody like you that has so many great people skills, sales skills that you've used to become rookie of the year, to become top at your company. Now, when you're a passive investor, you're placing your money with people and you're still building trust and building those relationships. But now when it comes to capital raising, you're really taking all the transferable skills that you've learned in your entire business career, and now you're just applying it in a different way towards a different thing. And so you're somebody that can step right in and be successful because of all those transferable skills that you have in your other industry.
Absolutely. 100% agree with that. The transferable skills piece. The other side of it is, I've really tried to identify what my investor avatar is, right? I would say that my avatar is not an investor that is a professional engineer or a doctor or an airline pilot, right? The industry that I have known for the last 2 decades and where I know a lot of others is really in the professional sales career, which sometimes can be people like real estate agents, right? Or really anybody that would be considered a high achieving sales professional. Those are really the people that I identify, the best with. And they're also the people that identify most with my story as well.
So for people that want to learn more about Starting Point Capital, or even just kind of real estate syndications, how can they get a hold of you and reach out and learn more?
I'm relatively active on LinkedIn, so your audience can look me up there under Jeremy Dyer. And then I have a website, startingpointcapital.com. Again, that's startingpointcapital.com.
Awesome. Well, thank you so much, Jeremy, for coming on and sharing your perspective, both as kind of that passive investor early on to now being active yourself. And best of luck to you as you continue to grow in raising capital and placing it with amazing investments.
Mike, thank you for having me on the show.